So on Tuesday, the Minister for Finance announced a budgetary package of almost €3 billion, and that was made up of around 2.6 billion almost in increase in current spending, of which about 170 was new social protection measures. There's about 800 million in additional capital spending announced, and that was in part financed by an extra 426 million of net tax increases. And so I kind of want to say, from the outpoint, it seems, and again, I'm sure it'll be interesting to hear the Fiscal Council's view on this next week, but it seems like the overall fiscal stance is quite prudent, with extra spending on top of the amount above if there is a no-deal Brexit. But what we really want to focus on today is essentially the highlighted bits here, which is a small part of the budgetary package. And again, that's something worth stressing from the start. That really what the budget did was to allocate increased money for public services, pay and investment. And there wasn't that much new measures on social protection and taxation. Nevertheless, there was some quite important measures, and we're going to kind of focus our comments on those. So what I'm going to do over the next 15 minutes or so is to assess these direct tax and welfare measures. I'm going to look first at the direct tax changes. Then I'm going to look a bit at the indirect tax changes, where most of the action on Tuesday actually was. And we're then going to just say a brief word at the end about the welfare changes. So I think the biggest thing on the direct tax side of things that was announced on Tuesday was a cash freeze to most tax credits and bans. And that amounts to an effective tax rise given that there's inflation and earnings growth. So this is for two reasons. Firstly, inflation erodes the real value of tax credits and bans. So if you have a personal tax credit of 1,650 this year, it's simply worth less to you in terms of the real goods and services that you get next year. So it's eroded by inflation, and it means that's an effective tax cut. But there's another reason, what economists call fiscal drag, in our beautiful jargon. And that is essentially that you have more people paying tax on more of their earnings, because earnings are increasing while those bans and credits are staying fixed. So it increases that effective tax burden on workers. So for those two reasons, that's why we would, in the economics world, would call holding tax credits and bans fixed a real tax cut. But it's not just economists. The government, in their summary economic statement, described the non-indexation of tax bans and credits as a discretionary revenue-raising measure, aka a tax increase. So just to show you that, this is item H in table A1 of Annex 1 of the summary economic statement. Kind of sets out that the government does also consider this a tax increase, at least in the summer. It mightn't announce it on budget day itself. So it wasn't tax cuts. It wasn't tax increases all around. There were some tax cuts, in particular for home carers and the self-employed. So they're going to pay less tax, and the reason for that is twofold. Firstly, for home carers, there was a €100 per annum increase in the home carers credit. It costs around 8 million a year, and that's going to bring that up to about 1,600, benefiting around 80,000 married couples, where one spouse is mostly working at home, caring for dependent child or adult. There's also going to be a €150 per year increase in the self-employed tax credit, costing 35 million per year. So this is the one called the Earned Income Tax Credit. So that's going to reduce the less favourable income tax treatment of the self-employed, bring them close but not quite the same position as employees on the income tax side. But they are going to continue to face the 3% universal social charge surcharge on incomes over 100,000. However, and kind of more significantly, the self-employed still benefit from very favourable PRSI treatment, and that's despite the elimination in last year's budget of any substantive difference in welfare entitlements. So those were done away with really, and there's no real difference in the contributory entitlements a self-employed and employed person gets. And what that means is there's now a substantial tax differential to carrying out economic activity in different forms. So what I'm going to show you here is the total income tax, universal social charge and PRSI that's associated with an annual income of 40,000 if you're an employee on the left-hand side and self-employed on the right. So if you're an employee, you get pay €5,640 in income tax next year. You pay 1,123 in universal social charge. You pay in Class A PRSI 1,600, and then there's an employer PRSI contribution of 4,420, giving you an overall tax burden of 12,783 next year. Self-employed will pay a little bit more income tax, so 5,790 is what they'll be paying, because their earned income tax credit is slightly below the PAYE one. They'll pay the same amount of universal social charge at this level of income. They'll pay the same PRSI in terms of Class S, is the same as Class A. But that's all, and so that means that there's a total tax burden associated with that of 8,513, leaving quite a big difference of 4,270 at this level of income. And so this is something that actually the OECD have been drawing attention to in recent years. They've pointed out that the tax differential across different legal forms of employment can encourage some people to carry out that economic activity as self-employed. And so from that point of view, it feeds into the debate about bogus self-employment that's been ongoing, but it hasn't really been, I suppose this tax differential hasn't really been part of that debate. And again, the previous rationale that had been given for this, the differential in contributory social welfare benefits, doesn't apply anymore. So that's something perhaps that might want to be looked at in future years. There are also some changes to other personal and business taxes. So there is a €15,000 increase in the capital acquisitions tax Group A threshold at a cost of a little over 10 million a year. What that means is essentially there's no tax now due on the first €335,000 of inheritance and gifts from parents to their kids, and so that was above indexation move on that threshold. There is also a reduced rate of universal social charge, which applies for medical card holders. That was meant to expire next year. It's now no longer going to. It's going to be extended at a cost of 60 million next year, and if it's done in the future, it's going to be a bit more. So that's quite a chunky tax cut there. There's also the extension and expansion of various tax breaks for businesses, and so together these cost around €80 million a year. There's quite welcome to see there was on budget day the department published a whole bunch of evaluations of these measures, and that's a very welcome move that these tax expenditures are being evaluated and they're going to be evaluated again in future years, and so it's important that those evaluations feed into whether these things are extended or not again. But perhaps actually the biggest tax raising measure was a raft of anti-avoidance and compliance measures that are very much going to keep revenue busy next year, because they're slated to raise 175 million extra per year from next year. So that really was the largest bunch of measures that the government announced, and they were specified. They think in particular dividend withholding tax, that changes there are going to raise a lot. But it's worth noting that these things are just inherently uncertain how much revenue can be raised, and they are a substantial part of the net tax package that was announced on Tuesday. There were also two major property-related tax changes. The first was the extension of the Help to Buy scheme until 2021 at a cost of 200 million for those 2 years. It's going to cost that's what Help to Buy will cost over those 2 years. Help to Buy was introduced in mid-2016 with the stated aim of helping first-time buyers obtain a deposit. And the way it does that is that you essentially get an income tax or dirt rebate on up to 5% of the mortgage that you're taking out if you're a first-time buyer. So the idea is you only have to get to 5% deposit. Government will top you up the other 5% through income tax that you paid, and then you've got your 10% as demanded by the credit bank's macroprudential rules. So it's been far more expensive than anticipated. So it's been 100 million this year alone, and that compares to when it was originally announced, Help to Buy was going to cost 130 million over its two and a half years. So it's been a lot more expensive than that, and that the government have kind of factored that into the costings, so the costings have now been updated to reflect this. But it also seems to be funding a lot of claims for homes at the higher end of the distribution. So over half of claims have been for homes worth more than 300k. So this isn't targeted at lower value homes, even accounting for the fact that that new homes cost more than old homes. But more strikingly, 40% of the claims had a loan to value of less than 85%. That means 40% of claims already had that 10% deposit before they got the top-up from government. So from that point of view, this looks like a particularly poorly targeted policy that could add to house price growth in the coming years. And from that point of view, it's something maybe that's worthy of a bit more discussion. There was also an increase in stamp duty on commercial property, raising again another hefty chunk, 141 million per annum. Transaction taxes are particularly an efficient form of taxation. Economists tend not to like them because they essentially prevent the person who values an asset most from holding it. And so in this context, what you can think about is a business which owns its own premises, would like to move somewhere else, say, I don't know, away from the Docklands down towards Merrion Street or something like that. But they're essentially dissuaded from doing so because to do so requires selling that property for less than you otherwise would, purchasing another property and paying stamp duty on it. So it means that businesses maybe aren't located where they would ultimately like to be. However, there is a certain coherent rationale for raising it. So it was raised a few years ago from 2 to 6%, and Tuesday's raise was a smaller 1.5 percentage points on top of that. But essentially, the construction sector some people, including the Fiscal Council, point to potential overheating in that sector. Given limited construction resources available, there seems to be a certain rationale to trying to dampen down commercial construction activity and push that activity towards residential. So there's a certain degree of rationale, even though it's maybe not a particularly efficient form of taxation. However, on Tuesday, most of the action was on indirect taxes. So there's a very sensible change to vehicle registration tax, raising €25 million per year. And so what's essentially happening there is that the 1% diesel surcharge that's paid on the importation of a new or used car into the state when you pay VRT, that's being replaced with a new nitrous oxide levy, which is going to be levied on the basis of the nitrous oxide emissions per kilometre driven. And particularly for those of us who are asthmatic, that seems like a very welcome move, which is aimed at tackling the external air pollution costs from motoring. So we should expect to see fewer highly emitting diesel cars being imported into the country from next year on. So that's a welcome kind of move there. However, it's worth noting that the largest external cost of motoring isn't air pollution costs. It's not even accidents on the basis of EU figures that are put together. It's actually congestion in urban areas. And that's something which remains entirely untaxed in Ireland. There have been some discussion of the need for, in the Department of Finance's tax strategy group papers, of maybe looking at a road pricing system which would vary by both location and time that has been driven, therefore tackling the congestion. But that's not something we've seen any movement on yet. But that is the single biggest external cost for motoring, and something which we might want to address in coming years. The entire, more kind of generally, the entire system of motor taxation is in need of radical reform if we want to maintain revenues from motoring taxes. And that's because improving emission standards are eroding the revenue base, not just of VRT, which the main rates of which are based on emission standards, but also in terms of motor taxes, which again are based, where motor taxes are based on your emission standards. As cars are getting more efficient, we're going to get less tax from those two, along with fuel duties as we move towards a more electrified fleet. So there's a few billion there in revenues which are at risk of disappearing entirely in the coming years, particularly if the government's successful in achieving its plans of switching over to electric vehicles. So there really is going to need to be radical reform if we want to maintain taxation or revenue levels from motoring, and that's something which we'll need movement on. Excuse me. Otherwise, on the indirect tax side of things, there was also a cash freeze to all excise duties bar tobacco. So given we have forecast inflation of 1.4% next year, this amounts to a real cut in alcohol duties and fuel duties as well, although that's somewhat offset by the carbon tax, which I'll come to. The tobacco duty, there was announced a 50-cent increase in a pack of 20 cigarettes, which the government's tax policy costings document says will raise almost €60 million a year. Revenue actually estimate that that's within the range, but they say it actually could also cost €40 million a year. So there's this very wide range of what that might raise. And the reason for that is essentially that one of the main reasons that we have a tobacco levy is that people will smoke less, is to try to deter people from smoking. So if that's the case, and they do it in sufficient numbers, we're not actually going to get any additional revenue. There's also the issue of substitution, either to cigarettes not bought in the state, legally or illegally, and also then switch toward vaping, which is less heavily taxed. So there's a lot of uncertainty actually around how much that revenue will raise, how much revenue this measure will raise. But what's gone into the costing is at the very highest end of what's revenue say this could raise. The item that's perhaps actually attracted most attention over the last few days since the budget has been the long anticipated increase in the carbon tax. So it's increased from €20 to €26 a tonne, raising on a full year basis €130 million per year. We saw overnight increases on petrol and diesel, which actually in the grand scheme of things don't add very much to the price of petrol. So they add a little less than 2 cents a litre. The bulk of actually even the tax on petrol and diesel is fuel duties, it's not carbon tax. And so from that point of view, it was a very minor change to petrol and diesel. It's going to be a little bit more substantial in terms of solid fuels, but that's not happening till May. And essentially there's been a whole strand of research that the ESRI has published this year which suggests that this measure will act to reduce emissions with very limited impact on the wider economy. And that while there are regressive impacts because lower income people pay a larger share of their budgets on fuel, those can be mitigated through a revenue recycling scheme. Now, what the government announced it was going to do was going to ring fence the extra money for climate measures. But the main measure that they announced, the €2 increase in fuel allowance, isn't going to compensate the lowest income households. And that's for a very simple reason. What I'm showing you here is the population split up into 10 equally sized groups of disposable income adjusted for family size, so deciles of income as we call them. Lowest income on the left, highest income up there on the right. And what I'm just going to show you is the proportion of households in each of those deciles that receive fuel fuel allowance. And very straightforward, less than 40% of those in the lowest income tenth of the population receive fuel allowance. And that's because fuel allowance is more so received by people in the second, third and fourth deciles, in particularly retired people. The reason for this is fuel allowance is a means-tested benefit available to people who long-term recipients of certain other welfare payments. And the levels are very much set around actually with reference to the state pension. So most of the people who end up being entitled to it are pensioners. So, and pensioners aren't the poorest in society. They are, when you adjust for family size, even on an income basis, not looking at housing costs, they are a little bit higher up the income distribution. So this measure, the increase in fuel allowance, really isn't going to compensate, I suppose, the lowest income tenth of the population in particular. In terms of welfare changes, there was very little other change. There was a cash freeze to the main rates of welfare payments and also to the thresholds there. That's a real terms cut given in living standards, given that we have a 1.4% forecast inflation rate. I think on this it's worth saying that if we do end up with a hard Brexit and we end up getting differential inflation, maybe get a different rate of inflation, that particularly affects food prices. Food makes up a higher share of the incomes of of the expenditure of lower income households, And so what that means is that we could end up in a situation where actually the cut to living standards end up different to what we anticipate at the moment. So that's, I think, just something worth noting. One of the welfare payments which did see an increase was what are called the increases for qualified children. They're the additional payments that are associated with most welfare benefits for essentially to help people with the cost of having kids. As of last year, these are now differentiated based on the age of your kid. So you get a higher IQC if you have a kid aged 12 plus than if you have a kid aged 11 or less. These have again been increased differentially, so the IQC has been raised by €3 a week if you have a kid aged 12 plus and €2 if it's less than that. And what that the rationale that was given for this when it was introduced last year was essentially older kids cost more. However, there's an entire body of economic research which shows that early childhood is a very formative stage of life and that things that happen in early childhood can go on to have very important long-run consequences, both in terms of like your health, your labour market, various different outcomes. And so there's a good argument that actually if you wanted to invest money or you wanted to differentiate payments, having that to children, younger children, could be a more effective way of spending resources. But that's not what we're doing, and there hasn't been really much of a conversation about necessarily this measure. And it's quite a dramatic departure in terms of how the welfare system treats children, and something that hasn't really been discussed, but maybe deserves a bit more attention. Finally, on the welfare side, it was announced that the Christmas bonus is going to be paid in 2019 at a rate of 100%, as was entirely expected, but at a very chunky cost of 280 million, because this is a very expensive measure. So this is something that successive governments have done over recent years. It's essentially announcing very late in the year it's to be paid in the budget for the following year that they actually are going to pay the Christmas bonus this year. And that's something which generates needless uncertainty for lower income households in terms of they can't be sure that they're going to get that Christmas bonus until quite late in the year, but also generates uncertainty for the public finances. It means that you're relying on revenues coming in more than anticipated, expenditure being less than expected, or having supplementary budget estimates to pay for this. And so it's, we really don't think that the government is, unless under the most strenuous circumstances, not going to pay the Christmas bonus. So we really should be in a position where we just put it in the books for next year. But as it stands, it hasn't for next year again. And so we can expect the public finance plans that have been announced to maybe change again should the government decide it's going to pay the Christmas bonus, or be reliant on, again, on other revenues coming in above profile. So, to conclude after that whistle-stop tour, the extra spending in 2020, I think the big takeaway is that that's really been focused on public services and pay. And that's been partly funded by effective tax rises on most workers, indirect tax increases and a raft of compliance and anti-avoidance measures. There has been an increase to some welfare payments, but most have been frozen in cash terms. But within that, the scope has been found to extend some tax breaks, cut gift inheritance tax, and along with some income tax cuts for home carers and the self-employed. I want to just finish up before handing over to Karina, who's going to go through the distributional impact of these measures taken together, to just comment on the budget process itself. So I think there's some very good positives, recent developments in recent years, which is one example of which is the publication of the Tax Strategy Group papers in autumn. The fact that the government put out the options that it's considering then, and for scrutiny for stakeholders and indeed NGOs, and they can point out any issues that this might create, is really, I think, a positive thing that improves public debate around the tax measures that we ultimately enact. The same can't really be said about the documentation of costings. That's very limited, that is published on budget day. And that makes it very hard to assess the assumptions underlying this, or what the costings are going to be into the future. And from that point of view, it's maybe one of the very few things we could learn from our colleagues across the water in the British government, in that they have the way that they set out their budget estimates is quite a lot more advanced around the costings in particular. They publish a lot of information on budget day, and that's maybe something that we might want to look at in the coming years. But for now, I'll hand over to Karina, who's going to take you through the distributional impact of these measures.